There is growing evidence that the housing market in the United States may be declining more quickly than it did in the 2008 crisis. This has led to suspicion that the decline in housing values may be more severe than many experts had anticipated. Welcome to Proactive Investing. In our current period, the most talked about topic is the real estate crash. We all know that there was a severe attack on the real estate market in 2008, and now the same situation is predicted to happen this year. Will this reach the extreme condition of 2008, or will it subside easily? For more contradictions on this, continue watching the whole video. The Oracle of Omaha, Warren Buffett, the most influential economist in the world, Jeremy Grantham, a legendary investor, Charlie Munger, CEO of JP Morgan Chase, Jamie Dimon, and the renowned investment guru Michael Burry all foresee difficult times for Americans in the months to come, particularly for business owners and stock market participants. According to them, the US economy is rapidly worsening. There are many things happening in the world around us, including rising inflation, a possible recession, a collapse in the housing market, an endless war in Eastern Europe, supply chain distributions, and so much more. But Michael Burry's regular predictions are very interesting and have a 95% success rate. On August 12th of 2022, he warned investors that a bear market rally was almost complete and we were heading for a new bottom. You might be surprised to learn that the market has dropped by almost 17% since that date. In a research released on March 29th, the Dallas Fed warned that the housing market is brewing a bubble for the first time since the early 2000s. The prices are unhinged from fundamentals, according to the authors, and buyers are behaving in an unsettling manner. The research received the most extensive media coverage of any scholarly article on housing's future in recent memory, and for good reason, thanks to the rebirth of the B word by such a prestigious institution. The spectacular run-up from 2002 to 2007 that sparked the Great Financial Crisis was the last time we witnessed a takeoff like the one we are currently experiencing. After 7 prosperous years of rises that were far above the average, US home values took off in the spring of 2020, increasing by an incredible 31% since then, according to the data from the American Enterprise Institute's Housing Center, and is still at a raging 17% annual pace. Cities like Austin, Phoenix, and Tampa, which are seeing high population growth, are moving over at twice the rate. We are in odd times, so it's remarkable that investors should be having such a bad time 2 years after the COVID-19 outbreak started. Due to the 4-decade high inflation and the Federal Reserve's hawkish response, the markets have collapsed. No significant asset class, stocks, bonds, real estate, and cryptocurrencies have escaped this damage. Average investors need to keep their heads down until prices stabilize. And according to Awifin Devitt, Chief Investment Officer at the assessment firm of Moneta, average investors are feeling quite raw and vulnerable. Even still, the general state of the economy and the country as a whole isn't quite as awful as it was nearly 15 years ago in 2008, which was described as an absolutely shocking year with no place to hide. Even though the economy shrank in the first half of the year, there is relatively little unemployment, and salaries are increasing, even though if they're not keeping up with inflation. For instance, the banking sector is not yet prepared to collapse. The demand for homes has decreased significantly from its high since 2008, as 30-year fixed mortgage rates are heading over 6% for the first time since then. The National Association of Realtors, or NAR, data show that year over year, house sales decreased by about 20% in July. Furthermore, single-family rentals are mostly to blame for the increase in rent costs from the previous year of almost 30%. The fact that this reflects such a large number of prospective home-buying families choose to rent rather than make a down payment on a home. But it's not just about demand. The United States saw a 10.4-month supply of new homes in July, which is the highest level since 2009. In recent years, housing starts to have significantly exceeded the growth of households. In other words, there are more houses being built than there are families to buy them. However, the price-to-income or PI ratios for residences are arguably the most shocking. The PI ratio is 16,035 when using a median new home price of $438,076 and an average hourly wages of $27.32. For reference, the previous high was 14,928 during the Great Recession. Thus, this is the greatest number since then. Home prices remain out of reach for the majority of working Americans in reflection to wages. Therefore, the demand for homes is unlikely to increase absent a significant decline in real estate prices. Clearly, the real estate industry has slowed down from its explosive growth in recent years. Depending on who you ask, the housing market could see a significant downturn similar to the one that occurred after the housing meltdown in 2008, a milder slump or a slowdown in home price increases. Fed Chair Jerome Powell forewarned of a difficult housing correction in the minutes of the Federal Reserve's meeting on September 21st. In the long run, Powell added, supply and demand need to better align themselves so that housing prices rise at a reasonable level and at a reasonable rate, and that people can again afford houses. Is inflation worse in 2022? Well, compared to 2008, inflation is considerably worse today. In addition to significant gains in 2021, the Consumer Price Index, or CPI, shows that prices are rising more quickly than they have in the period since the 1980s. Inflation won't likely return to normal until 2023, according to experts. Investors are being severely hurt by the Fed's strong hawkish move toward higher interest rates and quantitative tightening, while consumers endure the pain of a more expensive meat and rent. When interest rates were almost zero and the economy was still contracting in 2008, this wasn't a concern. Dramatic events that showed how the stock market was doing punctuated the 2008 financial crisis. Lehman Brothers, for example, failed. The chief executives of the biggest banks in the country pleaded with the New York Federal Reserve Bank for money. Hank Paulson, the U.S. Treasury Secretary, pleaded with Nancy Pelosi, the Speaker of the House, to support passage of the infamous Troubled Asset Relief Program, a massive bank bailout. A rise in housing inventory can indicate that some homeowners are in a hurry to sell because they don't believe their properties will appreciate in value or for other monetary motives. Fundamental economics informs us that a scenario with a high supply and low demand would lead to lowering prices in either case. According to our incredibly flimsy assessment above, 2022 has been the worst for investors since 2008 by a score of 3-2. Every investor has a unique experience, and everything depends on how your portfolio is associated to its various asset classes. However, the larger context of both years cannot be disregarded. In 2008, there were some times where it seemed as though the whole global financial system, if not that of the United States, was about to implode. The current unemployment rate rose to heights not seen in generations during this time, and it took over 10 years for it to stabilize. Recessions last for how long? The two-headed economic malaise that left the nation scarred was the housing crisis of 2007 and the protracted Great Recession. The median household wealth is still less than it was prior to 2008, according to the Federal Reserve. When viewed from this wider angle, investors had it worse in 2008. However, 2022 is still ongoing, and this year has only brought awful news. Therefore, hold on, and let's hope that 2022 ends better than it started. And that is all for today. I hope you've got a clear idea about the possible real estate crash in 2022. Let me know what your thoughts are in the comment section below, and don't forget to hit the thumbs up button and subscribe to our channel if you enjoyed the video. Also, check out other videos on our playlist and our channels. We'll be back with you for another video very soon, but for now, it's goodbye.